Relationship actually exists between the dividend and financing option of an organization. If an organization chooses not to pay dividend because dividend is actually discretionary, it's only that the way the shareholder will perceive it too may make it either easy or difficult for the organization for equity financing. It may not, but they have relationship, whether or not, depending on the objective of investment of each shareholder. Having said that, basically we want to look at dividend policy of the organization or of any organization. And when we are talking about dividend, it's a critical role of a CFO, of a finance person, which we had earlier dealt with in this video, the three areas of finance for financial or finance manager had been dealt with. Dividend is important. Now we want to look at this. We had earlier looked at products development, looking at market scheming and market penetration, the difference. And next, we are actually going to be looking at types of dividend, having done and dealt with what we need to consider in dividend policy, in dividend declaration as a corporate finance person and as strategic financial management person. So when we are talking about dividend policy, there are some things that we need to consider or in declaration of dividend. One of it is the legality or legal jurisdiction in which our organization is working from. Where are we located? What law governs the environment? What regulatory bodies do we have? And what are their laid down guidelines and principles that may affect our organization? Having said that, it is important that we take our law into consideration before we declare dividend or not. Please, it is highly important. Let's take, for example, some organizations will not pay dividend, not because they don't want to pay it, but because there are some rules that they must abide with. And some organizations will always pay it because there are some regulations that favor payment of such dividend in their country. So as a finance person, we need to first of all understand and consider very well. Having the knowledge of our governance environment is important. Then we need to understand who our shareholders really are. It is important. What are their perspective? How do they perceive dividend payment? It is funny enough, not always are we going to have those shareholders that love dividend payments, because investments objectives are actually different. We may say that everybody wants money in their pocket. Yes, that is true. But do I want to believe we all agree also that fiat money is not the only money that we can have? Money is about value that we have, and values are not necessarily in one currency or in one paper. Do we understand that? So the second thing we need to consider is how the effect of our declaration of dividend to our shareholders, which we can call clientele signal effect. That is, how would our shareholders perceive us? Take, for example, a shareholder that's invested in our organization because they want to reduce their tax liability. They have enough money and they are trying to save their money from government tax. You know, it is possible, especially if you are in a country that has like a progressive tax rule in which you are almost in the tax bracket. You are almost in the tax bracket. If any organization that you've invested in, like your savings, you have that investment as savings to you, but they now declare dividend, and having received that dividend, it takes your income into the bracket of large tax payments, which you are trying to avoid before you saved that money in form of investment with them. You will not be happy because the objective is not met, even though they are putting money in your pocket, right? But they failed corporately in the area of your investment objective. So clientele signal effect is important. How does our shareholders perceive us if we pay tax, if we pay dividend rather? So we need to understand it. If we've not been paying dividend, there will be some shareholders that loved it, and we will have been accumulating them in our organization. That is, they are being added to us. And if we are dividend paying organization, we will have those that love to receive yearly, biannual, annual, quarterly dividend attracted to us as a corporate organization. So if we now shift our policy, then it's going to affect them, and we've failed them because there are reasons why they joined us or subscribe to our maybe public offer or subscribe to us as a shareholder and the like, or investor. Another thing that we need to consider in dividend declaration is our organization dividend policy, payout policy. Some organizations have policy as to what percentage of dividend are they going to pay. They have policy as to they are not dividend payer as an organization. They could have policy as dividend paying organization, and so many more. This will be the next topic actually that we'll be dealing with under the types of dividend. So I'm going to elaborate more. But for now, we are considering things we need to understand and deal with before we start to declare dividend in under dividend policy. Next thing we must consider as an organization, especially if we are leveraged, that is, as a part of our financing, we take maybe loan, we have preference shareholder, redeemable shareholder, and the like, which are not basically equity. We have bank loans and the like, and part of the agreement before we obtain the loan or all those financing is we have restrictive covenants in those agreements. What are restrictive covenants? Restrictive covenants are agreements or clauses in the loan agreement or financing agreement in which we enter in that are restricted us, pardon me please, for doing one thing or engaging in one thing or the other during the period of our loan repayment, for example. If we have such, and part of the restricted agreement or clause is that you will not pay dividend until you fully pay back our money. If such clause or clauses are there, then we must consider it under our dividend payout policy or dividend policy. That restricts us from dividend paying. It's another very important thing that we must consider, because failure to consider and adhere strictly to covenants, to restrictive covenants, will make our credit rating to drop, and you know what that means. It becomes the implication is that it becomes more difficult for us to source finance. So no organization, no finance manager, no chief financial officer will want that to happen to the organization. So restrictive restrictive covenant must be adhered to and must be considered. Also, our cash policy or our cash commitment rather. What are cash commitments? Don't forget, when we are talking about dividend policy, dividend actually is like thank you that we do to our shareholders, and is not mandatory. It is discretionary. That is, we do not have to pay it, unlike the interest we pay to our preference shareholder and other sources of finance that have interest bearing. Dividend is equity. They are the owners. We pay dividend to the shareholders, the owners of the business, to say thank you for standing by with us. So it is not mandatory that we should pay. So we pay when we know that it is conducive for us to pay. So if we have cash obligations, more important cash obligations, it's better as a finance manager to pay those our obligations, to meet those obligations and the requirements before we start to think about our dividend policy or our dividend payout to our shareholders. Having said that, also, we are going to talk about another one. Before I mention that, I want to believe all have subscribed. And if you are yet to subscribe to GJ's Associates, please, will you go and subscribe now? Click the notification, click like to this video you are watching, and share and comment if there are any other areas that you want us to deal with as we are moving on. The next video will be on types of dividend. So another thing we need to conclude on in consideration of our dividend payout is our investment opportunities. Our investment opportunities. Here we have so many areas we can put money to and generate more wealth to our shareholders while paying dividend. If we can invest, we can plow back into the organization and make more money. If there are other investment opportunities, why do we have to pay dividend that is discretionary, that is optional, that is not mandatory? Doing that, we need to go back now to the signaling effect to the shareholder, the clientele effect. It may simply means to some shareholders that, okay, we have so much money as an organization and we do not have, or we do not know what to do with them. And some business managers, I'm talking now about investors, may not really like that style of organization as executive, to be running an organization in such a way. Don't forget there are different types of shareholders' objectives. Some people want dividend, they want it now if you can pay it every day. And some do not want it, they invest to save their money and take it away from the reach of tax brackets and the like. So we need to understand that before we declare dividend. So our investment opportunities around us, how have we dealt with them? How have we utilized the opportunity before we say we want to pay dividend to our shareholders? So it's been a while. I will not want the video to be long as we've agreed on, but if there are things to take home, now we need to understand the legal jurisdiction of our organization before we declare dividend. We've spoken also about our clientele signaling effect. That is, how would our shareholders that will be receiving dividend from us, how would they perceive us if we pay dividend? Are we actually helping them? Would they like it? or would they not like it? What were their objectives before they invested into our organization? We need to understand it very well so that we will not fail their objective. And if we fail their objective, we know the consequences. They will begin to withdraw their investment from us, and no corporate leader will want that. Another thing is our own dividend policy, our dividend payout policy. We must know it. Some organization will always, let's say 40% of our earning, we are paying 40% of our earning. Anything below that, we will not, the shareholders will not be happy. Anything above that, the shareholders may not be happy too, and the organization may not that moving forward with the speed it's supposed to have. Another thing we've talked about is our restrictive covenant, especially if equity is not the only financing option that we have. If we have debt as equity, as a source of finance in form of, let's say, bank loan, preference share, any interest bearing funding, we need to pay attention to the clauses that we have in the agreement before we obtain them. Also, we spoke about our cash commitments. What we need to spend money on, actually, they are very important. We spend money on them before we give money back to our shareholders. And also, it is important for us to know that dividend payment does not necessarily need to be about cash giving out, cash paying out. There are other types of dividend that we can pay out. We will talk more about it in the next video. Last but not the least is our investment option. How long have we explored them? Have we explored our opportunities around our organization, around our industry, that we've better utilized and generated more wealth to our shareholders before we say we want to pay dividends? If not, our shareholders may not be happy, and they may perceive the board of directors to be lazy-minded and the like, and would not want our organization and leadership to be perceived like that. So if you are a finance manager, if you are a student of finance and accounting, as professional, as master's student, please like, subscribe, share video. Gbenga Olatunji FCA from G. James Associates. Next, we'll be looking at types of investment, and we'll talk more about dividend policy. We have value to life. We have value to your businesses.